Hello everyone, welcome to the market opening bell for Thursday, 26 February 2026, your 10-minute guide to the stock market. Hong Kong stocks followed the positive lead from overseas markets on Wednesday. The Hang Seng Index opened 154 points higher, widened its gains during the morning session and hit an intraday high of 26,870 points, up 279 points in the afternoon. It closed up 175 points or 0.7% at 26,765 points. The H-share index rose 26 points or 0.3% to 9,034 points. The Hang Seng Tech Index fell 10 points or 0.2% to 5,260 points. Total market turnover was $236.7 billion. Southbound trading totaled $92.5 billion, while Southbound funds recorded a net outflow of 4.057 billion Hong Kong dollars from Hong Kong stocks. Southbound funds net bought Tencent for $880 million, Meituan for $677 million, Alibaba for $606 million, Xiaomi for $538 million, Yangtze Optical Fiber and Cable for $182 million and SMIC for $168 million, while net selling the tracker fund for $4.41 billion. Hang Seng China Enterprises Index ETF for $1.137 billion, Costco Shipping Energy for $357 million, and CSOP Hang Seng Tech ETF for $300 million. According to statistics, Southbound funds have now net bought Meituan for 6 consecutive days, totaling $3.3 billion, SMIC for 4 consecutive days, totaling $980 million, and Xiaomi for 4 consecutive days, totaling $3.207 billion. Mainland A-shares opened higher and kept climbing. The Shanghai Composite rose 29 points or 0.7% to 4,147 points. The Sunshine Component Index gained 184 points or 1.3% to 14,475 points. The Chinex Index added 46 points or 1.4% to 3,354 points. Combined Shanghai and Sunshine turnover reached 2.47 trillion yuan. The renminbi central parity rate was set at 6.9321 against the US dollar, up 93 pips from the previous day, marking the strongest level since 11 May 2023. Hong Kong Financial Secretary Paul Chan delivered the 22627 budget. He raised stamp duty on residential properties valued above $100 million, but left other stamp duties unchanged, causing most property stocks to fall. The budget also proposed fast-tracking the inclusion of REITs into Stock Connect, and Link REIT rose 0.8% on the news. In the financial section, Chan said Hong Kong will actively support national strategies to promote renminbi internationalization and continue reforming the securities market. The government will legislate this year to optimize the tax regime for family offices and funds and introduce a licensing regime for digital asset trading and custody service providers. To further enhance the securities market, attract issuers and improve efficiency, the Hong Kong exchanges and clearing will in the first quarter consult the market on revising the weighted voting rights listing rules, facilitating secondary listing for overseas issuers, streamlining IPO processes, and providing more flexibility for biotech and specialist technology companies. In the first half of the year, it will finalize improvements to the structured products listing framework and consult on the detailed implementation of T+1 settlement. It will also reform the board lot trading and, together with the SFC and the industry, roll out a paperless securities market system within the year. Further reforms will include optimizing the continuous regulatory framework for listed companies, issuing issuing specific guidelines for secondary listings by overseas firms, adding more overseas exchanges to the list of recognized exchanges, and exploring an over-the-counter platform for delisted or specially treated shares. HSBC Holdings released its full year 2025 results at midday. Overall performance beat market expectations, although pre-tax profit dipped due to base effects. Dividend and buyback policies remain robust, and the stock jumped 5.5% to $142.7. 2025 revenue reached $68.3 billion, up 4% year-on-year, and beating consensus estimates of $67.36 billion. Net interest income was $34.8 billion, up $2.1 billion year-on-year. Reported pre-tax profit came in at $29.9 billion, down 7.4% year-on-year, but well above the forecast of $28.86 billion. The CET1 capital ratio remained steady at 14.9%. The board approved a fourth interim dividend of $0.45 per share, bringing the full-year dividend to $0.75 per share. HSBC also launched a new $3 billion share buyback program. The bank raised several long-term targets, signaling strong confidence. Return on tangible equity of 17% or above for 2026 to 2028, excluding significant items. Net interest income of at least $45 billion in 2026, and ongoing cost-saving measures targeting $1.5 billion in annualized savings by the end of 2026. Nine Dragons Paper announced interim results for the 6 months to 31st December. Revenue reached 37.221 billion yuan, up 11.2% year-on-year. Sales volume hit approximately 12.4 million tons, the highest in 3 years for the same period. Gross profit rose 67.4% to 5.347 billion yuan. Gross margin rose 67.4% to 5.347 billion, driven by a 2.7% increase in average selling price and lower coal and energy costs. Net profit surged 218.8% to 1.966 billion yuan, with earnings per share at 0.42 yuan. No dividend was declared. New industry capacity additions are nearing completion, with expansion expected to slow sharply after 2026, easing supply-demand imbalance. Leaders with high wood pulp self-sufficiency, such as Nine Dragons and Sun Paper, can better hedge pulp price volatility and capture excess profits. A relatively stable yuan helps lower imported waste paper and pulp costs, while domestic consumption is recovering mildly, supporting resilient packaging paper demand. In technical analysis, the Hang Seng Index rebounded but remains capped by the 10-day moving average at 26,853 points. Today it may test this level again. A successful break above it would open the path to the 20-day moving average at 26,981 points. US stocks rose on Wednesday, led by Nvidia, Microsoft, and Oracle. The fear gauge VIX fell 1.6 points or 8.3% to 17.9. The Nasdaq climbed 1.3% or 288 points to 23,152. The S&P 500 gained 0.8% or 56 points to 6,946. And the Dow rose 0.6% or 307 points to 49,482. The Nasdaq China Golden Dragon Index, which tracks Chinese ADRs, fell 35 points or 0.5% to 7,545. Nvidia rose 1.4%. After the close, it reported fourth quarter results ended 25th January that beat across the board and gave a very strong outlook. Revenue reached a record $68.127 billion, up 73% year-on-year and 20% quarter-on-quarter, beating estimates of $66.21 billion. Data center revenue was $62.3 billion. Data center up 75% year-on-year and 22% quarter-on-quarter, exceeding forecasts of $60.69 billion. Non-GAAP gross margins stood at 75.2%. Net profit grew 94% to $42.96 billion, with adjusted earnings per share at $1.62, beating expectations of $1.53. For the current quarter, Nvidia guided revenue to approximately $78 billion, well above consensus of $72.8 billion and implying 77% year-on-year growth acceleration. The forecast excludes China data center revenue. CEO Jensen Huang said the Agentic AI inflection point has arrived and enterprise adoption is exploding. Blackwell demand remains extremely strong, while the next-generation Vera Rubin platform is already in full production and will start shipping in the second half of 2026, with Meta and other hyperscalers having already confirmed. Nvidia has strategically locked in capacity and inventory, with total committed supply now standing at $95.2 billion. The stock rose more than 3% in after-hours trading, pushing market capitalization close to $4.8 trillion. Software stocks continued their rebound, with Oracle up 1.2% after multiple upgrades. Microsoft fell, rising 3% and Palantir gaining 4.2%. Netflix rose 6% after executives headed to the White House today to discuss the potential acquisition of Warner Bros. Lois bucked the trend and fell over 0.5%. Fourth quarter net profit fell 11% year-on-year to $999 million, with adjusted earnings per share at $1.98, beating estimates of $1.94. Revenue was $20.58 billion, also above expectations. Same-store sales grew 1.3%, beating the expected 0.2%. Full-year guidance called for total sales of $92 billion to $94 billion, up 7% to 9% year-on-year, and adjusted earnings per share of $12.25 to the 12.75, which fell short of consensus estimates of $12.95. Oil prices were little changed ahead of US-Iran talks. Several OPEC Plus sources said the group is expected to approve a small production increase of 137,000 barrels per day at this weekend's policy review meeting, the same minimal hike as late last year, despite money institutions warning of a severe global crude surplus this year. Prices have not come under pressure yet, partly due to escalating geopolitical risks and production disruptions across North America, Kazakhstan, and Russia that continue to delay the oversupply wave. Our stock pick today is Jiangsu Synergy Battery Technology, stock code 3677. Synergy is primarily engaged in lithium-ion battery manufacturing, with a core focus on the research and development, production and sales of power battery products, energy storage battery products, and aviation battery products. Its power battery products cover BEV, PHEV, EREV, and HEV vehicle models, meeting the requirements of multi-purpose vehicles including sedans, SUVs, and MPVs. Energy storage products span residential energy storage, large-scale energy storage, and commercial and industrial energy storage. Aviation battery products are applicable to electric manned fixed-wing aircraft, eVTOL, and similar applications. The group offers integrated solutions covering battery cells, modules, battery packs, battery clusters, racks, and battery management systems. In addition to solidifying its position in the passenger vehicle power battery market, it's committed to expanding large-scale applications of electrochemical products under the land-sea-air interconnection framework. The group's power battery customers include major central and state-owned enterprises, new energy vehicle startups, and leading multinational OEMs. Its battery supply share in core models of global leaders such as FAW, Hongqi, GAC Chongqi, Leap Motor, SAIC GM Wuling, SAIC GM GAC, Toyota, and Volkswagen has continued to rise. The group is also deeply involved in the development of multiple future-oriented innovative electrification platform projects. Its joint venture, Xinzhongyuan Toyota, supplies a range of lithium-ion and nickel metal hydride battery packs adapted for HEV vehicles to core HEV models at Toyota's major joint venture OEM plants in China. Based on 2024 sales volume, Toyota holds over 70% of the HEV market share in China. In the energy storage segment, the 104AH standardized battery cell, primarily developed by the group, has become one of the leading supply products for global residential energy storage. Through partnerships, its products are now sold in markets across Asia, Africa, and Latin America. Additionally, the group's aviation battery business has achieved phased milestones. It has secured airworthiness certification together with Liaoning Tonghang's fixed-wing manned electric aircraft RX-1E and is on track for large-scale mass production, positioning it as the industry's first battery supply for mass-produced and delivered fixed-wing manned aircraft. The currently mass-produced model is a second-generation 3-highs 1-fast aviation power battery, which employs dual semi-solid-state technology. This represents ongoing iteration of the 3-highs 1-fast core performance indicators: high safety, high energy density, high power output, and fast charging, first pioneered by the group in the industry in 2023. The group's aviation battery products currently hold both AS9100D Aviation Quality Management System certification and Aircraft Airworthiness certification, providing dual validation of safety and technical capabilities. Dual-certified battery companies can secure a first-mover advantage and better capture opportunities in the future electric aviation market. In Q2 and Q3 2025, the group received additional orders and designated projects from its major customers. However, both existing production capacity and the new capacity from Phase 1 of the Changshu new production plant upon completion Q4 2025 have already been fully allocated to orders from other existing customers. Therefore, in October last year, the group raised approximately $500 million through the placement of 45,921,000 new H shares to accelerate capacity expansion, particularly the construction of Phase 2 of the new Changshu plant in order to meet anticipated order demand for 226 and 227. Recommendation: buy at $9.20, target price $10.20, stop loss at $8.70. I do not hold the aforementioned stock.